Greetings, Module 22. Let's talk budgeting. So why the heck do we budget in the first place? Well, think about a family that budgets. Kind of important to be able to do that. Kind of be able to track where your funds are coming from, where they're going, what you might have left to spend, to invest, even if you're planning for retirement. It is equally, if not more so important for a business to plan when you have multiple employees dependent on the success of the business. So you really need to monitor and track where you are and where you are going. So we're going to talk about budgeting and some of the reasons for budgeting, and then we'll do some of the techniques on how you budget. So let's start with the reasons. Why are budgets important? Well, we're looking at towards the future. We're trying to predict, we're trying to obtain, we have goals, we have directions, and we want to be proactive in how we allocate our funds. It's also a nice mechanism for communication and coordination. It's a backdrop that says, okay, here's where we're going to spend or invest, and here's the resources we need and we'll use, and here's kind of what we have left. Gives you a guide, gives you a direction. It also is a mechanism to evaluate performance. So you can see, well, how do we do compared to budget? Nonprofits, especially, as well as for-profits, both need to be strong in budgeting because you can't spend more than you have, no matter how much you'd like to. It also aids in risk management and reducing the risk of failure or closing the doors that goes with that sometimes. So let's talk about risk management. And there are positives and negative impacts on both sides. But risk is when things won't go according to plans. Tornadoes and hurricanes, they kind of are high risk. Fires, governmental actions. But there are some positive potentials as well. So we might actually have more sales than we thought we would, which means we have to have more production, higher stocks, find resources, or we might have increases in the selling price, which in theory should wash directly to the bottom line. So if you increases prices 10%, you have the same amount of expenses, your profits will actually go up more than that 10%. Some of the negative side of the potential risks that you look at, supply chain issues. May not have enough chips for those vehicles that are stacking up. Or if you don't have enough batteries or you don't have enough steering wheels, again, you won't be able to finish with what you're making and what you're doing, and supply chain kicks in as a limitation. And then there's fire, and we can't forget cybersecurity and the advent of hackers and the ability for disruption of business from the technology side. How do we manage that risk? Part of that process is identifying, evaluating, and planning for those possible risks. Some of those can be insured against, and some of those are not really insurable or accessible. So the budget itself can be one of those major tools in helping manage risk and minimizing the financial impact. And we have a little chart here that talks about risk identification, and you usually brainstorm potential risks and what those implications might be. You predict the possibility. Now, just because it's a remote possibility doesn't mean you do contingency planning just the same. But you want to quantify where those are at. Someone may, out of left field, frivolous lawsuit, which may not be so frivolous, or other things you need to plan for. Set up a response. How do you mitigate the risk associated? How do you avoid it, transfer the risk, mitigate the risk, or even just accept the risk and roll with it? And you monitor as you go. So this is some of the basic sides of why we budget and how risk impacts our budgeting process. So let's take a closer look at some of the types of budgets we're going to be using and the approaches we have. 4 categories we'll talk about: the output-input approach, activity-based. You might recall hearing about activity-based costing. Well, this is also activity-based budgeting approach. We'll have an incremental approach and the minimum level approach. So when we look at those, we start looking and saying, okay, what's our output-input approach? Well, we have budgets for physical inputs and costs based on the planned input levels of the individual units. The starting point, though, is the outputs. And we want to say, okay, how many do we need? And let's backtrack. How many things do we need to get to make 100 cars to go ahead and produce whatever products or services that we are going to be providing? And this is used not only in manufacturing and production, but it is used in service and merchandising, wholesale retail merchandising. Work effectively with activities that have been defined relationships between effort and accomplishment. So you can say, okay, here's how many of these I need to get so many of those. Now, we're not just budgeting materials, we're also budgeting labor and overhead, and we'll see how that fits together. So if we had an example, suppose 5 yards of material for every pair of pants. Each yard costs $10 a yard, and the company will manufacture and sell 100 pairs of pants. Multiply that all out, 10 yards times 5 times 100 pairs, we got $5,000 in our budget using a standard cost and a standard quantity. Standard cost of $10 and a standard quantity of 5 yards. Our input-output emphasis is placed on the expected cost of the activities that will be consumed. Again, I mentioned materials, but I'm also want to include labor in that calculation. Budgeted costs are computed as the projected use of each activity multiplied by the cost per unit. So materials is usually easy to track. We have cost per yard, cost per pound, cost per unit. On labor, usually cost per hour. And sometimes we have to factor in overtime. And we have to figure out where we're going in terms of labor requirements and how that fits in together. So suppose a clothing manufacturer, we want to set up machines for a production run. It costs $250 for the setup. 100 pants are produced on 10 runs. Then we budget the cost of the $250 per run at $2,500 for the setup side of things. Incremental approach, coming period is a dollar or percentage change from the previous budget. So we often see that with governmental entities. They say, yep, 5% increase, 3% increase. You might see wages, 2%, 5%, 7%, whatever it might be. It's used when the relationship between inputs and outputs is weak or non-existent. It's actually preferred to have an actual relationship with what we're trying to do with what we have if we know the exact quantities that we can project. But if we're not sure, we do a percentage. Government and not-for-profit organizations are often commonly using this as a technique, especially for providing services that they want to budget and see where they're going. So suppose that current material spending is $3,000 and the company expects a 10% increase. We just up our material budgets by that $300, 10% of $3,000, which makes for a $3,300 materials budget in this case. Then we can look at a minimum level approach. So we have a base amount for budgeted items, and we go ahead and we determine what's going to be above the base. Questions necessity for costs included in the base budget of the incremental approach. It is a time-consuming process. So it's for any quantities above a minimum base. You have to determine the base, and then you have to determine the increases associated with that. And finally, we have something called zero-based budgeting. Again, you might have heard of that in a governmental environment. Zero-based budgeting doesn't start with a base level and add 10% or 5% or 3%. It starts with zero. We're basically justifying every expenditure every time, starting with a zero budget. So we are combines elements of activity-based and zero-based budgeting with a need to live within a fixed financial constraint. So we want to see what we have for resources, and we want to understand we have some limitations, and we need to work within those limitations. That concludes this particular section. We'll do a deeper dive into budgeting. I'm going to go through a master budget. We're going to go through some standard costing. We'll go through budgets of actual. We'll have variances. We'll see all this good stuff in the very near future. Thank you for listening.